Hello guys, Dave Santarelli here. Just in the past 5 minutes after posting my last video, I seen you guys want to learn about the straddle. So I just made this presentation here very quick within the last 5 minutes about the straddle so I could get 2 videos in just one day here. So here we go. Options trading, the straddle. This short presentation is about trading a straddle option. The straddle. A straddle entails buying an at-the-money call and the same at-the-money put. The idea is that should the underlying significantly increase or significantly decrease, the value of the call or the put can be sold for more than the cost to purchase the two positions. You profit. So right here, here's an option chain from ETrade. We have Facebook right here. We're going to stick with that. We have the September 25th, 2015 expiration. Here are the strikes in the middle. Here are the calls to the left and the puts to the right. Now for an example here, for a straddle, we see Facebook is near $86 a share. So the best strikes would to be by the 86 strike call and the 86 strike put. The 86 strike call we see right here, it's trading around $4.25 per contract. The $86 strike put is trading, it says here 368, but here we have the bid of 405 and the ask at 435. So let's say we go somewhere in the middle here and say the 86 strike put is about $4.20 per contract. The total of the 86 strike call and the put is $8.45. So if we add 425 and 420, that's $8.45. This means to break even at expiration, we need Facebook to have at least an $8.45 move up or down at expiration. So we need Facebook to be above $94.45 or below $77.50 to break even, and this is for on expiration day. The straddle here. Now here is the option chain from TD Ameritrade. This one already has the straddle listed. So if we see here, here's the strikes, 86.86. The bid is 835, ask is 895, so I was at what, 845, so we're right in the middle there. We can still make a nice profit without Facebook having that $8.45 move. All we are saying is that at expiration, Facebook needs to be above or below our 86 strikes by $8.45. If Facebook has a $5 move up in the next week or two, then our calls are going to increase significantly and we can still have value in our puts since there is still extrinsic value or time value and implied volatility value. So in this case, if we wanted, we could sell the straddle for a pretty decent profit if it has that $5 move in the next week or two. To double our money, we would need Facebook to go above or below our 86 strike by $16.90 at expiration. It's important you guys understand that. That's at expiration. If Facebook has a, say, $10 move in the next week, then I'm sure we will double our money because we will have the calls worth money and the puts be worth money. Whereas expiration, if say the stock's at $90, then the calls are going to be worth money and the puts will be worthless. So that's just saying that at expiration day, we need the stock to be up or down $16.90 to double our money. So at expiration, we need Facebook to be at 102.90 or $69.10 to have a double on our calls or puts. But like I said, if it has a 3 to 5% move in the next week or so, we can surely sell the straddle for a profit since we have extrinsic value or time value on our side for both the calls and the puts. This is a strategy most traders sell for a profit before expiration date on a decent move up or down, since both the call and the put will still have value, whereas if you hold until expiration, like I said, the one will have value and the other will be worthless. So this is a strategy you usually put on if you think, like for example last week, you see the market's in turmoil and you think it's going to go lower, then you could put on a straddle and you'll make money if the stock goes down. And then that's another strategy you could think of here. If you have the September 25th expiration, you can take advantage of this volatility in the market, because you could then sell your puts. Say next week the market goes down 500 points like it did. Well, this past week it went down 1,000 points. So say next week it just goes down 500 points. You could sell your puts probably for a good double. Okay, since the 86 strike put here is only worth $4 and what do we say, 25 cents? Or I think it was $4.25. So if Facebook had that $8 move or even like a $6 move, there's still going to be time value on that. So we could sell our puts for a double, and then we could just keep our calls until expiration. So say the market goes down next week, we make a nice profit on the puts, so we sell the puts and take our profit on the puts, and we just keep our calls and anticipate that the market's going to start bouncing back up since we had that big correction last week, and sell the calls on any kind of gain that Facebook has from after next week until expiration date. So there's many ways that you can work with a straddle. You can just hope for a big decrease or increase in the stock value, or sorry about that noise here, some guy's on his motorcycle. So like I said, you could hope for the big increase or decrease next week and then sell either the call or the put for a nice profit and then hold the other, or you can sell both of them, since both of them are still going to have time value and whatever intrinsic value the calls or puts have. So there's many ways you can trade a straddle. The straddle, like I said, is for an anticipated large move up or down. So there's many ways you could trade that here, and I hope this video helped you on a straddle. All right, have a great night.